quick video on my investment strategy. I've got $130,000. I'm going to put $30,000 just in my offset account for my house, which will get about 4% offset, and the rest I'll be spreading into the share market, probably over a period of 5 buy-ins. So you split the 100,000 into 20,000. Actually put $25,000 in today. I put into this company, this ETF, which owns different shares over the share market. It's a high yield ETF, so it means it invests in shares with higher yields, and they have researchers that look at the forecast and not just the current yields, because obviously there's dividend traps out there. Companies put out a big dividend, next year there's no dividend, but obviously this group does the research on that. So I think I bought it $45 today. I've lost money. I'm not worried about that, because all the companies I bought are 40 to 30% down. So anyway, let's go look at what it is. So $45, they sorry, just waiting for it to load. Okay, so equity yield 5.8%. That's not correct. That was on the 29th of February. So obviously the stocks have come down 20%, so you're getting a bigger yield. But also saying that the companies might not be paying out as much, so it could be coming down depending on the earnings forecast for these companies. But here's the companies. I think they're 40% banks: BHP, Wesfarmers, which own Bunnings, Transurban, a toll road company. Toll roads, you can live in a desert island, invest in a toll road company, come back in 20 years, and you'll probably have a lot of money. So anyway, we'll see how it's allocated. Well, go back to page 1. So it's got high allocation in the banks, and obviously the banks are hedging their loans as well, so they're not just going to lose a lot of money, because people have houses and stuff. They're going to have to pay those loans, and the bank will probably take them if they don't, and maybe it'll crash the whole financial system. I don't know. So anyway, Wesfarmers got Bunnings. That's a really good company. If you remember, Bunnings tried to get taken out by the one that Woolworths had, Masters, and Masters really screwed up. They paid too much for the sites, and then Bunnings ended up buying them out. Well, buying the sites, that is, probably at a good low rate. So Telstra, not a big fan of Telstra, but not bad. Transurban Toll Road, I like that company. Rio Tinto, low cost miner. Macquarie Group, it's a bank, got a good dividend. Woodside, not a fan of petroleum, but they've dropped a lot, and people are still going to need petrol until the electric or hydrogen cars come out. Sydney Airport, yep, pretty rough time at the moment, but it's going to still make money in the future. Coles Group, up at the moment. Everyone's buying food. Fortescue's up as well, don't know why. AGL Energy, good energy company. They go renewables. QBE Insurance Group, not bad. Mining. Horizon. Tab, I like that one. Gambling, everyone's gambling. They own the lottos, so yeah. Coca-Cola, Boral, decent. Magellan, that's a good one. Magellan invests in good strong companies in the USA. Alumina, low cost aluminium producer. So they're all good companies on here. So you could research companies for days and days, and you might be buying these ones anyway. So yeah, and plus the prices have all come down on these, so even if they're not the best companies, you're buying them at 30% less anyway. Okay, so we'll go to distribution. Which I worked out, going off last year's dividends, you're getting about 7% at today's price. So add up all these numbers, divide it by $45, which is roughly today's price, and it's about 7%. So invest 100,000, that's $7,000 a year. So yeah, you're getting 7 grand a year. If the market goes too high again, you want to sell out and wait for the next crash and just get rich. Anyway, I'll show you when you might want to sell out. This is in the future. We're obviously in a good buying period. The Shilley PE ratio. So the PE ratio means you're buying the company at 30 times what it earns. So if the company earns $1 a year, you buy it $30. The PE ratio is 30, but this is all the companies in America. So when it gets to 30, it's never been sustainable. Not really much over 25 either. So if it's ever over 25, you most likely want to sell out. So right now it's coming down. It might even come down a lot further. Remember, the earnings could rise, which will factor in this chart as well. So it's a price to earnings ratio. So if the earnings go up and the price stays the same, then this is going to get lower, this number. You also want to look at the market cap to GDP. %89 at the moment, so that's probably a good time to buy. Historical low of 89%, so under 100 most likely indicates a good time to buy. Anyway, so that's how I'm investing. ASX 200, we'll go back to this chart. Also, you can never pick the bottom. So let's say this history repeats itself. Maybe I'm buying in here, but I'm going to buy another section in a month's time. So maybe I'll buy in here, maybe I'll buy here, in here. And then all this time I'll be going up and down, but the dividends will be coming in, so the price isn't too important. Over 10 years, that's $70,000 for 100,000 invested, and I've still got the 100,000 in the stock price anyway. And then you want to put your income into here, so you're buying 50 more thousand a year, and just compounding. You see the Shilley PE ratio get too high, sell out, put into fixed interest, and wait for another crash. It might be just around the corner.